We're seeing ADP numbers go the wrong way. That's the private payroll people. We're seeing, all sorts of anecdotal evidence that the economy is not doing well. Consumer confidence is super bad. And really, we're just waiting for the stock market bubble to kind of roll over. And that will be when the mainstream media kind of admits there's a problem. And we're seeing lots of issues in the plumbing of the financial system. There's a lot of Fed discount rate borrowing, although they're encouraging that. We're seeing credit starting to tighten. And this is just classic late stage economic cycle where the boom from the COVID bucks and the AI bubble rolls over and we get a run of the mill recession.
Hey everyone, my name is Anthony Fatsies and welcome to another episode of the WTFinance podcast. On this episode, I have the pleasure of welcoming back a very popular guest, Ed Dowd. So Ed is the founder of Phinance Technologies and author of Cause Unknown. So Ed, thanks so much for coming back on the podcast.
Anthony, great to be here. Good to be back.
Yeah, great. Looking forward to the conversation. We spoke at the start of the year, and yeah, it's definitely a lot has changed since then. So it'd be really interesting, starting very broad. What have you seen in the economy and I guess in markets over the last 6 to 9 months?
Well, so our thesis at the beginning of the year was that we're going to see the beginnings of a worldwide recession. We thought it would happen a little sooner, but it's coming into sight now. When we put out a report in January of this year, interest rates were, the 10-year was at 4.80. It's at 4.17 right now. The 3-month T-bill was a lot higher. We've had a couple of rate Fed cuts. Oil was at around $77. We said oil in our report was going to 30. It's now at 58 and change. So the real economy, there's the K-shaped economy that everyone's talking about. The stock market continues to kind of hover near all-time highs due to the effect of the AI bubble still kind of working its way through the system. There's about 7 to 10 stocks that really account for most of the returns this year in the S&P 500. Gold has trounced the S&P 500 this year. So both are up nominally. I think what's coming next for stock market returns, especially at these valuations, historically when you get to these valuations, forward projected 10-year returns based on history are 0. So that assumes a big drawdown between now and then. So we're seeing the real estate crisis we talked about, the immigration economic variable that I think I talked about on your show last time. Is starting to take hold, and we're seeing some bankruptcies. We saw Tricolor Auto subprime that lent mostly to illegal immigrants went belly up. First Brands and Aftermarkets auto part store went belly up, and Prima Lend, another subprime lender. So we're starting to see the effects of the Trump economy, which Trump is claiming it's the golden age. Unfortunately, he's a little early in calling that. There's a valley coming before his policies really will take long-term effects. It's going to take several years for the investments that they've announced to come here and break ground. That's nowhere near happening. Otherwise, employment would be skyrocketing. We see employment going the wrong way. We see mass layoffs. So we're seeing the hangover starting to appear. We're going to see credit continue to deteriorate. We're seeing credit card defaults rising. They're near all-time highs. And then auto loans are right behind that, and then eventually comes mortgage defaults. And we're finding out that the illegal immigration that supported the housing market, it was even worse than we thought. There's been discovery that the Biden administration was giving mortgages to illegal aliens to help them buy homes. So that's all unwinding. New tenant rents have been plummeting since the beginning of this year. They continue to go lower. The unfortunate thing is we've had a lack of data due to the government shutdown. So we're waiting on more data, but anecdotally, we're seeing ADP numbers go the wrong way. That's the private payroll people. We're seeing, all sorts of anecdotal evidence that the economy is not doing well. Consumer confidence is super bad. And really, we're just waiting for the stock market bubble to kind of roll over. And that will be when the mainstream media kind of admits there's a problem. And we're seeing lots of issues in the plumbing of the financial system. There's a lot of Fed discount rate borrowing, although they're encouraging that. We're seeing credit starting to tighten. And this is just classic late stage economic cycle where the boom from the COVID bucks and the AI bubble rolls over and we get a run-of-the-mill recession. China is also, we put out a China report about a month ago that's for institutions only. It's not priced for retail. And we show that China's acute real estate phase of their crisis is beginning, and they're going to have some serious problems in 2026. Interestingly enough, they've now decided to no longer report home sales, which is in our report. They also, in 2023, stopped reporting land sales. So they're trying to hide the data of how bad it is, and it's getting worse. And the trade deficits with China, I think, hit $1 trillion this year. That is a bad sign of them exporting deflation. They've had to ramp up trade exports since their demographic wall in 2020. And that's really what's keeping the engines and the lights on for them, because internal domestic demand is rolling over badly because of demographics.
Yeah, so you unpack so much there, really interesting. A lot of places we can go to. But I'd like to start, what do you think has extended this, I guess, cycle? Because as you said, I think, yourselves and your analysis thought that there's going to be sort of a crash in 2025. And I think you mentioned that in previous the previous cycle after COVID, you sort of saw something similar and were a little bit early to that. So yeah, what do you think sort of extended a bit further?
Well, there's been a lot of Ponzi finance and private credit extended to keep a lot of zombie companies alive. And the Trump administration is definitely trying to blow the AI bubble. That's if you look at what's been driving the last couple of quarters of GDP, it's been mostly AI data spend, which is not sustainable. That's going to peak out soon because there's no ROI on AI yet. They're just not making enough money. Just like in the dot-com bubble, all the benefits of the dot-com bubble economically came a lot later once pricing came down and the overinvestment was repriced. We're going to see the same thing with the AI bubble. A lot of this investment is going to, a lot of the debt is going to be repriced and a lot of the equity is going to zero. So that's just typical in a bubble. I'm not suggesting AI isn't a real technology. It is. It's just not ready for prime time. There's lots of studies showing that corporate pilots are showing no return on investment. You're hearing in the headlines that people are laying off people due to AI. I think that's just an excuse. It's easier to say that than to say the economy's rolling over and our business stinks. So that's what they're doing.
Okay, yeah, makes a lot of sense. And you mentioned the employment data; it's come back quite very negative, and sort of we've seen job reductions over the past few data points. Is that to do with a reallocation with this migration issue and with, I guess, a lot of people have been self-deporting or being deported themselves? Could that be a driver? I know there's also the people saying businesses are very tentative, especially with the geopolitical risks with sort of Liberation Day. So maybe if we were to look through it, then maybe that could be resolved, or you don't see that as?
Well, there was a lot of pull forward before the tariffs. So there's a lot of economic activity in Q1 and Q2 to buy as much inventory as possible before the tariffs went into effect. So that kind of distorted the economy just temporarily. The tariffs are definitely creating uncertainty. There's also a lot of indecision on investments, and the immigration variable, the elephant in the room, the new economic variable that we identified, is definitely going the wrong way. So they've halted people at the border, so there's no more inflows. They've been slower to deport, but a lot of people are self-deporting. But what they're doing is they're slowly shutting off all the freebies and goodies. The problem has been that the Democrats have been fighting mightily to keep those things funded. So it hasn't been as fast as we thought, but it's happening, and it's working its way through the economy. Real estate prices are just unaffordable for the average home buyer. There's been inflation in real estate taxes. There's been inflation in insurance costs and maintenance costs. So a lot of these home prices for the younger folks are just unattainable, and the only thing that's going to make it affordable is home prices coming down. In our real estate report that we put out in August timeframe, we showed a very telling graph. It showed homes for sale versus homes sold, and over time those things kind of track each other. There's not much difference, but we see this gap right now between homes for sale and homes sold. So there's a buyer's strike. So people aren't buying because they're priced out of the market. The only way to adjust that is prices, and it's slowly happening. A lot of the rents were supported. People buy speculative single-family homes and built a lot of multi-family tenant housing to accommodate the illegal immigrants. And new tenant rents are a forward warning indicator of demand, and those have been plummeting, and rents are finally coming down. And the people that own single family homes that they hope to rent out to people are unfortunately finding the rental market's repricing lower, and a lot of these people are underwater and can't even cover their full costs of ownership, even with new rents. So this is slowly going to, add more inventory to the housing market. Construction in housing is rolling over. New home builders are struggling. So it's the classic inventory cycle, a little bit of an overbuild, especially multifamily housing, coupled with no demand, unaffordability. And the only way to fix this is through prices.
Yeah, it seems very regional. I know, hear a lot about Austin, the amount of apartments and sort of homes they've built there, and then rents have sort of gone through the floor. So it seems to be very much, as you said, supply demand dynamics.
Yeah, the Northeast is still holding up, but that should, in the teeth of the correction, that should finally give up the ghost. Eventually, it will.
Okay, and what is the recession? What does this recession look like? Because I know you said there's lots of issues in the plumbing, of I guess, of the financial system and debt and credit, and I guess we're seeing sort of credit spreads, or at least liquidity, sort of drying up. Do you see it being sort of another financial crisis, or how are you watching this as a more sort of a slow, decrease in the economy?
We're not calling for a systemic crisis. If one appears, we'll call it in real time. The Fed has more tools available to them. They have not really implemented full-scale yield curve control. They could always do that, much like Japan did. Japan did that for 20 years effectively. Now Japan is losing the ability to manage its. It's reached kind of the end game for them, but we'll see what happens there. The Fed has more tools in its toolbox, so we don't think it goes systemic, but it's not going to be, a pretty recession. We did not have a systemic crisis in the dot-com bubble, and the stock market ended up going down 50% over 2 years. We think the stock market could go anywhere down 30 to 50% over the next, 12 to 18 months. And again, the only thing that's holding this up are 7 stocks. And once the AI bubble becomes apparent, and there's some early warning indicators that the AI bubble is maybe it's already burst or it's got one more push up, but we're seeing credit default swaps on CoreWeave, which is an AI darling, and Oracle's debt, because they're funding a lot of their AI with debt. The credit default swaps are rising. So financing is becoming more expensive for AI CapEx. And then we had the mysterious, strange, call by Sam Altman for federal assistance to fund AI, which is basically essentially, let's call it what it is. It's a bailout at the top, which means that they're signaling that financing is becoming more problematic. There's also a realization that there's no power really to plug these data centers into. So the data center projected announcements and CapEx spend plans have gotten way ahead of the ability to actually plug into the grid. So, the gating factor on AI building was NVIDIA chips, and now it seems to be power. And if you can't plug it in and turn it on, why would you build it? So we fully expect CapEx plans to slow. And once the market figures this out, valuations on these things are well extended. They'll come down nicely, and that'll probably be the beginning of the quote unquote short bear market for the major indices.
Yeah, you see it being quite a quick sort of crash and then recovery. It seems to be that's what we've seen the last, during COVID, and I guess 2022, 23 was a little bit longer, but they're still quite short, and then they sort of bounce back quite quickly.
Yeah, well, 22, 23, we should have had a recession, and honestly, if we did, we'd be better off right now than we are. They unfortunately juiced it with the illegal immigration. Ran 8% crisis level deficits and sent a lot of bad signals to the Fed, the capital markets, and corporations. So we have a ton of malinvestment over those last 2 years. The Fed is behind the curve mightily, and they're going to have to play catch up. So this could be a quick one, a painful one. It could also be long and drawn out, depending on what the policymakers do to try to hold this thing up and keep it cobbled together. So it'll be interesting to watch it unfold. The quicker this happens, the better off everybody is. You don't want to see this turn into a slow, grinding bear market that takes 2 to 3 years to complete. That won't be good for anybody.
Yeah, definitely. And if we go back to AI, you mentioned energy, and we look at Henry Hub, and it's sort of broken recent resistance and is going up to all-time highs. driven by AI demand as well as the LNG terminals and the exports. So there's sort of going to be a divergence between international LNG prices and US gas prices. So that's also another issue that we've seen. While Brent's going down, it's quite an interesting economy.
Well, and also let's think about, electricity bills are going up across the U.S., and that's due to AI power demand, and that's choking off consumer consumption. And 80% of the GDP of the U.S. is consumption. So, this is kind of an interesting dynamic where we're racing to build the AI system that's going to eliminate your job, cause your power prices to go up, and you're supposed to be expected to continue to demand good, do your part and spend. Well, the consumer is basically tapped out at this point. We've seen credit card delinquencies hitting new all-time highs. And so we're seeing people default there. That now we're seeing auto loans defaulting. And then finally, the last thing we'll see is the mortgage defaults coming. This is the classic cycle. People stop paying on credit cards first if they're stressed out, then their car, then their home. And people seem to forget the feedback loops. The credit feedback loops. We're going to start seeing inflation is a direct result of credit creation, and credit creation is usually kickstarted by the Fed when they print easy money. The government then spends it, and then the credit creation cycle begins anew. Then there's shadow banking people like private credit and non-banking institutions that create credit, and it's all good until it isn't. And then when it isn't, the feedback loops begin, and then we have credit destruction, and then a recession, and then we'll see the Fed come in with probably new QE. There'll be government fiscal policy response to the recession, and you're gonna have to worry about inflation again. But we got a bout of a deflationary scare coming. Housing is and shelter is 36% of the CPI calculation. Rents coming down are going to cause home prices to come down. And that'll be the cause of the majority of the deflation scare, and they'll try to reinflate again. Whether or not their efforts are successful, we'll have to wait and see, and we'll call it in real time. But my guess is they'll, go to the same playbook as usual.
Yeah, and it does seem that banks are just throwing credit at everyone. for anything, there's sort of been less risk dynamics. So as you said, once there's sort of that stops, then everything's just going to choke up.
And look, this could be a really beautiful self-correcting mechanism. I mean, if they rip the Band-Aid off, no policymakers will do this because we got the midterms coming up. But if we had a command and control economy, let the thing correct. If there were no politicians that had to worry about getting let it correct. Home prices come down to be some losers that over-lever themselves in the cycle, but the big winners would be the middle class and the millennials, the younger generation. They would buy a home, and then they'd start spending, and they'd start, putting furniture in the house, and the cycle would be renewed. This is classic. But the longer we let this drag out, the more they try to patch the holes, and the longer the homes are unaffordable for the middle class, the more there'll be social unrest and distrust of institutions, and this kind of battle between the older generation and the younger generation.
Yeah, I think you need to give people a stake in the system, and if they don't have a stake, that's where we get this volatility and the riots and the concern. And boomers have done well, but then a lot of their property prices have gone up. Even in London, I've seen places go up 30, 50, I think even 300 times over the last 40 years, and that's just been extreme luck versus potentially the hard work, even though everyone's been hardworking. But yeah, there's also a bit of luck involved.
Yeah, well, the biggest problem has been the central banking and credit creation system to keep kicking the can down the road. And what it's done is it's made the baby boomer generation, because of their placement in the demographic cycle, the winners of this easy money, which really began after we took the U.S. dollar off the gold reserve and created infinite amounts of credit and made the petrodollar and unhinged it. So the home prices is kind of rising is kind of an illusion, but it's a monetary illusion. So right now the incomes that the youth are getting is not enough to pay the mortgages, and so prices have to adjust. And that's what's going on in China. They way overbuilt for their demographic population boom, which kind of stopped rising in 2015. But after the great financial crisis, they continued to build way more housing stock than their population could demand. Now they have 20 years of inventory. We're not as bad in the U.S., but prices do need to come down so that people can afford and we can, restart the cycle. Now, if Trump's policies of tariffs actually work, and there's all this investment that's coming to the U.S. over the next several years, that'll take time to, get permitting and break ground and hire people. There could be a golden age on the other side, but to say there's a golden age now is just, bad messaging and at worst, and deceitful gaslighting at best. And because the average person is not seeing a golden age at all. A lot of people in their youth are working 2 to 3 jobs just to pay their rent and get groceries for their family, with both people in the marriage working those 2 to 3 jobs.
Yeah, it is crazy. And we're sort of seeing, the Fed has started cutting. It looks like they're going to have quite a big cutting cycle into 2026. It looks like potentially emergency liquidity and maybe QE coming back as well. Is that just going to extend this cycle and, as you said, potentially make it worse into 2026?
Well, the only way they're going to do emergency rate cuts is if things become unhinged, and the damage will already have been done in the financial markets. So they'll come in after the fact. They'll do their QE. They'll do their emergency rate cuts. It'll be too late because by the time that stuff works its way through the system, it takes about 18 months. So it won't save home prices. It won't save the stock market, but it'll cause probably another round of inflation. So we're going through this cycle of, overextend credit, easy money, inflation. They raise interest rates to take away the punch bowl. It eventually causes a credit contraction, and here we are. It's a roller coaster of bouts of deflation scares coupled with inflation runs.
Yeah, it makes sense. So, we talked about AI before, and you're saying that the potential shift in the economy and how it will impact it moving forward. Have you thought about that? I guess, have you thought about 10 years down the road and what the economy will then look like with AI and the impact it would have on society?
Well, that's the the $1 million question, right? So what is AI going to do? Is it going to be like every tech cycle, a productivity enhancer that eventually creates more jobs, or is this kind of the end game where AI and robots are going to make us obsolete? They're going to put people on UBI, and the idea is we need less people over time. I don't know. I'd like to be more of an optimist and hope that there is a kind of a new age coming, but we have to be vigilant about what AI could be used for. And there's a lot of people out there who think that AI and UBI will be tied to a central bank digital currency, and it's kind of a control system as we transition out of the industrial age into this new AI robotic age. So we have to watch this. We have to watch for human rights and freedoms. We have to watch for making sure that the rules aren't geared towards the oligarchs and those in power. But these are going to be the battles of the next 10 years. We definitely have a new monetary system coming because this debt-based credit fiat system is coming to an end. I don't think it's going to come to an end in this cycle. I think they kick the can down the road one more time. But you can see what the central banks and the commercial banks themselves are doing. They've made gold money again. Basel III rules made physical gold tier 1 capital, which means they can lend and create money against gold. So, there's definitely going to be a new monetary system. What that looks like, I don't know. But what I can tell you is gold is going to be a part of it, whatever that looks like. And what I find interesting is Tether, the stablecoin folks for Bitcoin, are buying tons of gold. I think they were the third largest purchaser of gold recently, which is ironic.
Yeah, it is amazing that most of their investments are in sort of government bonds, treasuries, and gold. So sort of there's meant to be this new currency that's then, being supported by a lot of these older assets.
Yeah, I don't think this is what Bitcoin was originally intended for, but here we are, and we'll see what happens. And Bitcoin, I'm not a Bitcoin maximalist, nor am I, someone that poo-poos it. It's a legitimate asset class at this point, but it's a volatile asset class that attracts speculative money flows, and it acts a lot like the NASDAQ, and it's 90 to 95% correlated with the NASDAQ. So if people think it's going to protect their wealth in a recession and a risk-off scenario, I don't think that's going to happen. There's a lot of people think it's going to decouple. Unfortunately, it doesn't look like that's happening right now. And Bitcoin peaked October 6th. And Bitcoin is a good indication of liquidity in the system. And liquidity in the system, if you believe that, Bitcoin is telling you that it's leaving the system. It's going to hit other asset classes eventually, the stock market, corporate credit, junk bonds, you name it. It seems like there's a warning going on in the Bitcoin market that liquidity is a problem at the moment.
Yeah, it always seems to be sort of a front runner of liquidity for that assets, as you're saying. So what do you think is going to benefit during this, I guess, mini crisis? Is it going to be traditionally, as we're seeing, government bonds, precious metals again, or do you think it's sort of going to be an everything bubble where everything goes down and then sort of comes back again?
Everyone seems to think that the U.S. Treasury market is toast. The dollar's going to zero. We have the other side of that. We think this is going to be more like other cycles. The bond market cares mostly about inflation and growth, and I'm talking the long end of the bond market, not the short end that the Fed controls. The Fed doesn't control the long end. That's controlled by inflation expectations and growth. And if I'm right on the economy, growth will be contracting, inflation will be coming down, and there'll be a bid for long dated paper, and it won't go down as much as short rates, but there'll be a bid. So if you're worried about what's going to happen to your money, I don't tell people what to do, but I would be raising cash in a government money market fund or T-bills to take advantage of lower prices. And if you're more speculative minded, you could buy long-term treasuries like TLT, but that's not for the faint of heart. So that's what we think. We think U.S. government securities, cash, gold and silver are doing well. They've had a nice run. They might consolidate for a while. Long term, we're very favorable on the outlook for gold and silver because of the tremendous demand from China, the central banks and the commercial banks. And there does seem to be a new monetary system coming. There's a lot of problems in the sovereign debt bubble, of which the U.S. is probably going to be the last to fall, but that's not for several years, maybe 10 to 15 years from now. We have to worry about our debt, but Japan has a debt problem. China has a debt problem, and there's demographic issues in South Korea, Japan, Asia, and Europe, and the EU has a debt problem as well, given their demographics. So I suspect the dollar, which has been weak this year, is going to have a giant rally into the 2026 midterms.
Okay, but looking at that midterms, as you said, it's going to be recessionary, so it could actually be, even though there's a dollar rally, could be quite negative for Trump. But then after that, you're saying there could be sort of a bit of a golden age post midterms.
Well, it depends on who Trump's successor is, whether the Democrats get in power, whether a lot of the tariffs and executive orders and deals signed come to fruition. There's a lot of ifs, but I'd like to think and be hopeful that on the other side of this, it's going to be good. But what I do know is prices will be a lot lower. So, don't bet against America. When prices are low and we're discounting the end of the world, that's when you buy. And then, what happens after that is anybody's guess, but it's usually less bad, and less bad means, stock prices go up. So stocks trade on the second derivative. And, as bad, I remember the great financial crisis in the bottom of 2009, people were, thinking the banks were going to get nationalized. Business results were awful, but things were so bad they could only get better, and getting better is good enough for really cheap stocks to start working. So you can worry about the Trump long-term plan after the bottom, because stocks will go up regardless by things just getting less bad, and that always happens at a stock market bottom. We go from it discounting badness, then it gets really bad, very bad, then less bad, and that's when stocks go up.
Yeah, is there anything else, anywhere else, I guess, in the world or any other markets where you're like, this is really bad, it can only get better? I guess bonds is a sort of long-term bonds is a prime example of that, but is there anywhere else that you're watching?
Well, once we get to the bottom of this cycle, you're going to want to sell all your long-term bonds. So you want to buy your bonds before before the stock market figures this out. Then when the stock market goes down 50%, you sell your safe securities and buy risk. So you want to do the opposite of what everyone's up to their eyeballs in risk. the economy is definitely rolling over. There seems to be this belief that it doesn't matter and the Fed's going to save us. And that the Fed does not save people at the end of a credit cycle. They are subject to the cycle just as anybody else.
Yeah, interesting. And it sounds like, I might be putting words in your mouth. This is sort of a now to 2030 period of a drop and then potentially golden cycle to at least 2030. And then from there, see what happens.
Yeah, I like gold into 2030. Long term, the charts look like it wants to go to 10,000. Silver will follow. That's a more volatile industrial asset. So if we go into a recession, silver might have some problems because it's tied to industrial production. But as we go into the uncertainty, there's going to be maximum uncertainty over the next 5 years. I mean, we have a lot of demographic headwinds. We have new technology coming in. We don't know what that looks like. We have a lot of social unrest. We have a lot of populism rising around the globe, and we have China has a serious problem, and they're going to need a scapegoat, so they might invade Taiwan at some point. The EU has a pension problem. They may want to continue to saber rattle against Russia to distract their population from their own policy shortcomings. So there's a lot of geopolitical risk out there, a lot of moving pieces, but I continue to believe the U.S. is the cleanest shirt in a dirty laundry, but we're going to have a little rough spot here. And then on the other side of it, you want to be more U.S. focused.
Okay, and this might be a shift more to geopolitics, but you don't see, there's lots of talk about the U.S. losing its, the hegemony, the global hegemony. Is that something you're seeing, or you think that regardless of that the case, it's still the cleanest shirt?
Well, there's definitely a policy of the Trump administration to get less entangled in foreign affairs just for the sake of it. When you analyze what happens to empires, and the U.S. is an empire, the real problems for the currency and the empire happen when when Rome fell, they called the legions home, and they were not able to secure the trade routes and enforce everything. If we start closing bases and pulling our troops back, that's when the dollar is in real trouble. I don't see any signs of us abdicating that authority. We still have one of the biggest nuclear arsenals, which, quite frankly, the world's reserve currency is backed by our Navy, keeping the trade routes open and the nuclear arms of the U.S. Now, if we start seeing closing of bases wholesale, then I personally become worried about the U.S. dollar. I don't see that on the docket anytime soon.
Yeah, and it seems to be more getting allies to contribute more. So Europe, Japan, other allies in the certain regions to contribute more. US focusing on America's Monroe Doctrine, as well as continuing to, as you said, I guess Asia is going to be a key factor moving forward.
Yeah, Asia is going to be a big problem for the globe, especially China. China has such a problem. There's 7 million card-carrying members of the CCP that kind of run 1.5 billion people. Their biggest fear is their own people. They need to keep them employed, so that's why they've been ramping up exports as their domestic economy implodes. And they're going to continue to dump cheap goods into the world's markets, which would turbo or destroy consumer-based economies like Europe and the U.S. and put people out of work here. So that's why there's trade wars. That's why there's tariffs. So this needs to be managed, and there needs to be actually some serious discussions with China to maybe help them transition from a mercantile economy, meaning there's very few people at the top to get rich, and turn it into a consumer-based economy where they develop a middle class. Now, the problem with developing a middle class is you give up some power. So China doesn't want to do that. They want to keep the same game going, but they have to worry about the 1.5 billion people and keeping them distracted and employed. And that's going to be the biggest challenge for China going forward, and it's a problem for the world.
Yeah, I'm not sure you saw FT release an interesting article yesterday, and they actually showed $1 trillion surplus from China. US surplus has decreased. Europe is sort of a bit flat. It's really been in ASEAN, sort of the Asian trading bloc, as well as others. So it's actually interesting. We said that the US and the West are the main consumers, but somehow they're exporting it to other regions as well. So they are finding buyers somewhere. But as you said, they're sort of probably desperate to find buyers wherever they can.
Right, and also let's not forget a lot of times they'll export to an Asian country who then takes that raw material or semi-made technology and then repurpose it and sell it to the U.S. It's kind of a way to scam their way around the tariffs. So I suspect a lot of those goods are finding their way into the U.S.
Yeah, Drew, really interesting. So, Ed, thanks so much for your time. We're sort of going in so many directions. I really appreciate you coming back on. I'm sure the audience do as well. But my last question is, what is one message you want people to take away from our conversation?
Look, there's nothing to fear here. There's opportunity in every correction. If you're prepared, you're going to be very happy on the other side of this at the bottom. If you're not prepared and you're up to your eyeballs in risk assets and leveraged trading accounts, you're at risk. And there's winners and losers in all these things. And I see opportunity. I'm not a gloom and doomer, and I think people should prepare. And you can find our research at financetechnologies.com, spelled with a PH, and I have a personal website, eddowd.com. I'm also on X, at Dowd Edward.
Great, I'll put it in the description below, but thanks so much for coming back on. Appreciate it.
Thanks, Anthony. Take care.